Ever wondered how the tax department catches people who try to game the system right before interest payouts? Well, welcome to this explainer on a truly crucial anti-avoidance provision in the Income Tax Act 2025. Specifically, we're talking about Section 175. Whether you're a practicing chartered accountant, a tax professional, a business owner, or a CA student gearing up for exams, understanding exactly how the authorities plug these revenue leaks is absolutely essential. Today, we're zeroing in on a very specific, heavily scrutinized financial maneuver. We're going to dive straight into the mechanics of how the law actively prevents tax avoidance through securities transactions. We'll unpack the rules, walk through a practical timeline, and cover the strict compliance requirements you really need to be aware of under the new 2025 Act. All right, so let's start with the exact problem the authorities are trying to solve here. Imagine a classic scenario that has tempted taxpayers for decades. Think about this. Can you dodge taxes by doing a quick little shuffle? Selling off your securities right before the interest record date and then instantly buying them back right after. Historically, this practice was known as bond washing. And honestly, it sounds like a pretty clever workaround at first glance. You temporarily offload the bond to someone who's maybe in a lower tax bracket or someone who has offsetting losses. They receive the interest, and then, boom, you get your asset back. But as we're going to see, the tax authorities are way ahead of this maneuver, and they have been for a long time. To completely shut down this exact loophole, we need to look at the legislative framework provided in our tax code. Now, it's pretty fascinating to see how the core anti-abuse principle has evolved. Section 94 of the old 1961 Act established the foundational rules for this. And now, moving into the present, Section 175 of the newly enacted Income Tax Act 2025 modernizes that language, but firmly retains the strict countermeasures. The whole goal is to ensure that interest income is taxed in the hands of the rightful economic owner, period. So let's actually get into the nitty-gritty of the legal mechanics of Section 175. Section 175, subsection 1, lays out the fundamental rule. It basically says that if an owner sells or transfers securities and then buys back or reacquires them, or honestly even acquires similar securities, any interest that becomes payable in that interim period is deemed to be the income of the original owner. So the absolute crucial point here is that the assessing officer has the statutory power to completely ignore that temporary transfer. They will tax the interest directly in your hands, completely regardless of who physically received the cash. But wait, it goes even further. Take a look at subsection 3 regarding beneficial interest. This part says that if a person had a beneficial interest in a security and through some convoluted transaction they end up receiving either no income or less income than what would have naturally accrued on a day-to-day basis, that accrued income is still deemed to be theirs. This essentially closes the gap. It ensures that anyone holding a beneficial interest cannot just artificially divert their accrued income through complex financial structuring. Okay, let's bring this down to earth with a practical, real-life taxation example featuring a hypothetical taxpayer. We'll call him Mr. A. Let's look at this timeline. On March 15th, Mr. A sells his bonds to Mr. B. At this point, there's no immediate tax on the sale. Fast forward a bit to March 31st, the interest payment date hits and the company rightly pays Mr. B. Then, just a few days later, on April 5th, Mr. A goes and buys the exact same bonds back. Now, despite Mr. B physically receiving the interest, this rapid sell and buyback immediately triggers Section 175. The law steps in, waves a red flag, and deems that entire interest amount to be the taxable income of Mr. A. So what happens? The assessing officer is going to look right through that transaction, totally nullifying any tax benefit gained by the temporary sale. The golden rule to remember here, especially for CA students and professionals, is the classic doctrine, form will not triumph over substance when this provision is invoked. The economic reality is ultimately what gets taxed. Now, the law isn't totally blind to genuine, everyday commercial transactions. The market does rely on liquidity, after all. So let's examine the exceptions and compliance points. Subsections 4 and 5 actually offer a bit of a safety net. If a taxpayer can conclusively prove to the assessing officer that there was zero intent to avoid income tax, they are safe. Alternatively, if they can prove the avoidance was purely exceptional, not a systematic pattern, and they have a completely clean history with no similar transactions in any of the 3 preceding years, the deeming provision won't bite them. And finally, if you are a bona fide dealer, meaning your actual day-to-day business consists of buying and dealing in securities, these transactions won't be artificially added to your income. This ensures legitimate market making isn't unfairly penalized. From a practical compliance standpoint, your documentation is absolutely your best friend here. You must meticulously track transaction dates against interest record dates in strict accordance with the newly prescribed Income Tax Rules 2026. Also, pay attention to the Section 536 Savings Clause. It tells us that relevant legacy circulars, FAQs, and guidance notes issued for the old Section 94 still help guide our interpretation today, provided they don't directly conflict with the new 2025 Act. Even when the rules seem black and white, we still see a lot of misunderstandings in practice. Here are a few major pitfalls to watch out for. First, ignoring the beneficial interest clause when structuring transfers between family members or group companies. Trust me, the assessing officer can and will look through those related party structures. Second, and this is a remarkably frequent error, assuming the assessing officer bears the burden of proof. Nope. Under Section 175(4), the taxpayer must proactively prove the absence of systematic tax avoidance to claim the exception. It is definitely not automatic. Finally, failing to retain contemporaneous documentation that proves a valid non-tax commercial reason for the trade, that will almost certainly lose you the argument during an assessment. All right, let's wrap this up and bring it all together. Here are your main takeaways. 1. Section 175 of the ITA 2025 directly replaces Section 94 of the 1961 Act. 2. It's explicitly designed to nullify the tax advantages of bond washing. 3. Any temporary transfers will result in the interest being deemed as the original owner's income. 4. Bona fide dealers and non-systematic exceptional trades are protected, but only if specific conditions are met and firmly proven. And 5. Proper, proactive documentation of your commercial intent is absolutely vital for compliance. Keep these 5 points in mind, and you'll be well equipped to navigate or advise on securities transactions under the new Act. Before we finish, I want to leave you with something to really think about. As algorithmic and high-frequency trading continue to evolve, where massive volumes of securities are bought and sold in literally milliseconds, how might tax authorities adapt their interpretation of systematic avoidance under Section 175 in the coming years? It is a fascinating intersection of traditional tax law and modern financial technology that all of us in the profession will need to watch very closely. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.